are not loving the tried and true 401k.
You wouldn't do retirement accounts?
Yeah, definitely not.
I have a lot of money in my 401k.
I'm sorry.
I thought
sorry
that was...
for you.
Your 401k is a scam. Yes, I said it.
While digital media often circulates warnings that the retirement system is a government trap, the reality is far more complex and involves structural decisions that are often overlooked. For those entering the workforce, facing life changes, or nearing retirement, the 401k is a powerful tool, but it is not as fundamentally flawed as many fear-based narratives suggest. However, the first 12 to 24 months of retirement are when the most critical structural decisions are finalized. Upgrading these financial, legal, and personal systems quietly before social pressures and celebrations begin creates the clarity required to set a successful 30-year trajectory. Most retirees wait until they file their first return to consider these upgrades, but by then, the income tone for the year has already been set. For decades, the standard financial advice has been to maximize traditional 401k contributions to receive a tax deduction today, based on the assumption that retirees will be in a lower tax bracket later. While this model worked for moderate savers with simple income profiles, it was not built for individuals who have maxed out contributions for decades and will have Social Security, rental income, and brokerage accounts all providing income simultaneously. Research indicates that those with significant pre-tax savings can easily land in the same or even higher tax brackets when mandatory distributions begin. Consequently, a 401k is not just a savings account. It is a bet that future tax rates will be lower than current ones, a bet that may not succeed for high-income earners. To move beyond fear-based narratives and ensure your retirement bet actually succeeds, you must implement these 10 strategic upgrades to establish a clear and successful 30-year trajectory. Upgrade 1. The 3-bucket withdrawal strategy. The primary shift in retirement is moving from a focus on saving to a focus on which accounts to pull from, in what order, and in what amount. Most retirees default to the traditional IRA because it holds the bulk of their wealth, but every withdrawal from that account creates taxable income that stacks with Social Security and affects Medicare premiums. A sophisticated strategy prioritizes tax diversification across 3 specific buckets. Tax Now, brokerage accounts. These accounts offer capital gains rates and full flexibility. They serve as the necessary bridge for early retirement and allow for tax loss harvesting, which involves selling losing positions to offset gains. Tax Later, traditional 401k/IRA, useful for reducing current tax exposure, and over-concentration here creates mandatory obligations that can grow faster than the government requires you to withdraw them. Tax Never, Roth accounts. These grow tax-free, have no forced withdrawals during the owner's lifetime, and do not trigger bracket creep or involuntary Social Security taxation. A 2025 study showed that 86% of retirement plans now offer Roth options, with high-income participants increasingly using them to balance their tax exposure. The goal is not merely to avoid taxes, but to control when they are paid and on whose terms. Upgrade 2. The Healthcare Bridge. For those retiring before age 65, employer coverage ends, requiring a bridge to Medicare. Marketplace insurance through the Affordable Care Act offers premium subsidies based on income, which remain accessible through 2026 despite tightened regulations. The withdrawal strategy chosen in Upgrade 1 directly determines the value of these subsidies. With a managed income structure, the savings can reach tens of thousands of dollars, whereas a poorly structured withdrawal plan can cause subsidies to disappear entirely. Upgrade 3. Capturing the match baseline. Regardless of long-term tax strategies, the first decision in any 401k plan never changes. Secure every dollar of the employer match. The match is the only guaranteed return in the investment world, providing an immediate return on capital that should never be abandoned. Everything above the match is where individual strategy and stage of life begin to matter. Upgrade 4. Rehearsing retirement and cash reserves. A successful plan requires moving beyond estimates to actual spending tracking during the first 3 to 6 months of retirement. This rehearsing of retirement provides a real number that a 30-year withdrawal plan can be built around, preventing unintended spending sprees or withdrawing from the wrong accounts. The emergency reserve. Retirement requires a more deliberate cash reserve, often 6 to 12 months of living expenses, held in stable, accessible accounts. Known purchases. Cash for major purchases planned for the first 3 years, such as cars or home projects, must be identified and set aside separately to prevent unplanned investment sales at the wrong time. Upgrade 5. The math of compounding tax obligations. Traditional 401k accounts experience strong growth that often compounds faster than the government requires the money to be taken out. At age 73, required minimum distributions, RMDs, begin at approximately 3.8% of the account. If the account earns 6 to 8%, the net balance climbs, causing the following year's withdrawal to be calculated on an even larger number. The IRMAA cliff. High income can trigger IRMAA, a surcharge on Medicare premiums. For 2026, this kicks in at approximately $109,000 for single filers and $218,000 for married filers. Exceeding the threshold by $1 can trigger an entire premium bracket jump based on a 2-year look-back period. Upgrade 6. Social Security strategic analysis. Selecting a claiming age based only on the monthly benefit is not a strategy. The optimal claiming age depends on how the benefit interacts with the withdrawal plan, Roth conversion windows, and IRMAA exposure. The IRS uses a formula called provisional income to determine if Social Security benefits are taxable. If thresholds are crossed up to 85% of the benefit can be taxed as ordinary income. Upgrade 7. Insurance right sizing and liability. The insurance mix used during the working years often becomes irrelevant in retirement. Disability insurance is no longer needed once earned income ceases, and life insurance may be unnecessary if the surviving spouse is financially secure. Conversely, umbrella liability coverage and long-term care planning become more important to protect assets from lawsuits or extended care events. While umbrella premiums have shown signs of increasing, the coverage remains a high-impact protection for accumulated wealth. Upgrade 8. Beneficiary designations and the 10-year rule. Most beneficiary designations were set years ago and have not been reviewed since. These designations override wills and trusts, meaning outdated forms can send assets to ex-spouses or unintended heirs. As of 2025, IRS regulations have finalized the elimination of the stretch IRA for most non-spouse beneficiaries. Adult children must now fully deplete inherited accounts within 10 years. Because heirs are often in their peak earning years, these mandatory withdrawals can push them into higher tax brackets and trigger their own IRMAA problems. Upgrade 9. Modernizing estate documents. Estate documents drafted when children were young rarely reflect the income sources and account structures of a modern retiree. Updating wills, healthcare directives, and powers of attorney ensures that trusted individuals have the correct legal authority to make decisions. Without these current documents, decisions are made by default by courts and those with the loudest voices in the room. Upgrade 10. The survivor strategy. A common planning failure is assuming the surviving spouse will be secure because assets are high and the house is paid off. However, the math changes significantly when one spouse passes. The survivor must file as a single filer, where tax brackets are compressed. RMDs continue on the full traditional balance, and Social Security taxation thresholds drop, causing IRMAA surcharges to hit earlier and harder. The survivor can end up paying higher effective tax rates on the same money with one fewer person in the household. Modeling this early provides a clear argument for accelerating Roth conversions while both spouses are living and brackets are wider. The objective of high-level retirement planning is to transition from reducing this year's tax bill to controlling total lifetime tax exposure. For those at peak income with large pre-tax balances already compounding, continuing to defer income may actually be working against their long-term interests. Every decision made with these accounts today is shaping what is possible for both the retiree and the next generation.